This is the BioCentury Show.
Brought to you by the 5th East-West Biopharma Summit in South Korea. In March, explore how to globalize Asia innovation and connect with key players across Asia's innovation arc, from India to China to Japan.
Welcome to the first BioCentury Show of 2026. I'm Stephen Hansen, Director of Biopharma Intelligence at BioCentury, and today I'm delighted to be joined by Adam Koppel, partner at Bain Capital Life Sciences. Adam has had two stints at Bain Capital, the first of which started in 2003, where he led the firm's public equity healthcare investing team for 10 years, after which he spent 2 years as EVP of Corporate Development and Strategy at Biogen. 2 years later, he returned to Bain Capital, where he has led the firm's growth of its life sciences team. Adam has an MD and PhD in neuroscience from the University of Pennsylvania School of Medicine, an MBA from the Wharton School at the University of Pennsylvania, and I don't want to leave this out, but he also has an AB and AM in history and science from Harvard University. Nice to know that there's a fellow history fan here as well. Bain Capital Life Sciences was founded in 2016 and was built on Bain Capital's 4 decades of healthcare and life sciences investing across private equity, public equity, credit, venture capital, and real estate. The firm invests in biopharma, diagnostics, medtech, and life sciences tools companies across the globe, with more than $6.5 billion in assets under management and more than 70 investments globally. Adam, Happy New Year and welcome to the BioCentury Show.
Thanks, Stephen. Happy New Year to you. And I want to thank you and the team at BioCentury for having me on this podcast. Looking forward to it.
We're super happy to have you on and to kick off this what I think is our 5th season of the BioCentury Show. And so I think the best place for us to start here is I know that your life sciences group is primarily focused on growth equity and the public market investing in the biopharma space, but historically, Bain Capital is really traditionally known as one of the major U.S. private equity firms. Given how private equity has shown a growing interest in life sciences in recent years, I'm going to start you off with a 2-part question here to kick things off. So first off, why hasn't the traditional private equity model worked historically in biopharma? And then to follow that up, can you talk a bit about how that model has evolved to where it is now, really being a consequential player in the biotech space?
Sure. Thanks. Great question. I think, historically, global sort of scale private equity has relied on ongoing business models, models that have free cash flow, stable revenue, and stable free cash flow, because a lot of times they're levered, and you need stable free cash flow in order to lever the business with debt. And also, I think both the investors making the decision, and also their investors, people that are expecting return by investing in the limited partners in funds, are expecting lower risk than is seen in most biopharma businesses. So I think that is the high level answer. Double clicking one more step, I think the other difference is the type of people that are needed to underwrite the investments in the biopharmaceutical space, and the risk that one would need to take in order to see good returns in the industry. And what I mean by that is, on the first one, who are the people that are actually making the investments? They're different. Generally, global private equity have generalist investors that understand business models and recurring businesses and stable growth in businesses, looking at revenue growth, margins, and ultimately free cash flow. In life sciences and in biopharma, we are forced to think through which drugs and medical devices and tools will work. And so there's clinical uncertainty, there's regulatory uncertainty, there's competitive uncertainty, and then there's business launch and sustainability uncertainty. So I think, frankly, that is the major reason why you've not often seen typical global private equity investors come into the life sciences market. You need different people to make those investments, and you need a different risk profile in order to be comfortable having those investments.
Right. So that risk profile largely still remains quite high, yet we've seen some of the private equity players start to come in, and I know you guys have started to make some scaled investments on this side. So can we talk a bit about what's the role for private equity now in today's biotech market? Where does it sit?
So I think the reason why you're now seeing more historically private equity companies or investment firms come into the life sciences is A, because the returns are there. We have seen good scale returns. There have been some massive winners over the last couple decades. Outside of the traditional pharmaceutical industry. So that's reason number one. And there's the need for capital. And I'm sure we're going to come back to this. What is that need for capital and how is it different? So the need for scale capital is number two. But I think the reasons why some of the traditional players have got more comfortable on top of the fact that they see return opportunities is that it's idiosyncratic return. It's sort of like, you've got to get it right. And it doesn't just depend on where the market cycles. It really depends on, can you identify the true winners in the space, the people that are creating value, the companies that are going to create value. And that can be technical. And so I think there's now been a commitment to hire in investment professionals that are capable of making some of those technical investment decisions. And now that the scale is matching the ability to do good diligence and make good investment decisions, you're seeing more comfort in entering the space. And I think a third point is around the way that some of these deals are structured. I think you're structuring deals now to protect downside while still enabling equity-like returns on the upside. And we can maybe get into that, like what are some of those deal structuring tools that are being used. But I think that the ability to find uses for scale capital deployment where you can underwrite with a group of dedicated investors that know how to look at these assets, and you can structure the deals in such a way to try to protect downside. I think this is what's giving some of the traditional private equity groups more comfort in entering the space.
Sure. No, I think that's a good point. I think we'll come back to the structure in a minute, but I did want to dive a bit deeper into these scaled investments. Can you talk a little bit about how, I know how you guys think about prioritizing what you invest in, when to invest, how much capital you need to deploy, can you just talk through some of that thought process?
Sure. Well, we do have a couple of criteria that we think about when we filter ideas, when we prioritize ideas on what to work on, and then B, we have a framework that we use when we actually make an investment decision. So why don't I maybe go through those two? In our prioritization scheme, we are looking for companies that are at a point of value inflection. We like to get involved with companies when they need scale capital, and that scale capital, that round of investment will really change the dynamic of the company that we're investing in. What we mean by that is we will be able to underwrite a major value creation event. Number one. So it's important for us to be able to say, what is that value creation event? Can we call it out? Can we specifically mention what it is? And in our space, it's oftentimes, a phase 2 readout, a phase 3 readout, regulatory clarity, a commercial launch, a partnership, items like that. So we require ourselves to understand what is the value creating event. Number two, we want to make sure we understand what's the time and capital required to get to that value creating event. We don't want to invest in amorphous opportunities where we don't know the time and capital required. So we're only invest in situations where it can be measurable and we can study what the capital requirements are to get to that major value creating event. The third criteria for us in prioritization is to be able to do the due diligence necessary to convert binary risk or binary uncertainty into skewed bimodal uncertainty, where we can get comfort 80-20 or better that when that value creating event happens, it will create value and not destroy value, right? We can get the 80+% confidence that we think that will be right on the investment hypothesis. And then finally, fourth, we have to be able to do a transaction or set up a term sheet in a way that between valuation and structure, we are going to get rewarded, or our investors are going to get rewarded for taking the risk that's required to invest in the life sciences. Because certain times, as good as we are, and as good as anybody would be at doing diligence in this space, you're going to be wrong 15, 20, 25% of the times. So you have to make sure that you're coming in at a point with value and structure that you can offset those times where you're just going to be wrong. And unfortunately, take some zeros or take some pretty close to zeros, but still overall in a portfolio having good return profile. So those are the four major points that we think about when prioritizing where we want to spend our time, even before we do the formal due diligence to ultimately make an investment decision.
And what can you just give me a rough idea as when we talk about these scaled investments, how big are these checks that we're typically talking? Are
Well,
these
it
100,
depends on the
200, 500?
situation. In our fund
Yeah.
one, which we, as you mentioned, we started our fund one back in 2016, 2017. I think our average capital deployment per investment was in the 30 to $40 million range. And that was total.
Hmm.
That wasn't necessarily all what was initially invested on day one. But we
Right.
thought about, let's say, 30 to $50 million investments in the companies with initial investment plus commitments plus also reserves. I'd say now we're at the point where that number's over $100 million on average, right?
Hmm.
So there's certain investments where we're comfortable making $200 to $300 million investment, but there are also we want to give ourselves the opportunity for large return potential investments to make $50 to $100 million investments. So it
Yeah.
certainly has scaled in the last 10 years, and it's larger. But you could also then go on and ask the question, there's certain private equity like investments in global, I'll call it widget investment private equity, like industrials, technology, consumer, which are in the billions equity check.
Hmm.
And we haven't done too many in the billions, but there is one or two examples in our collaborations with Bain Capital Global Private Equity where we have crossed the billion. But those I think are much rare.
Sure, sure. Part of the reason I ask is because, I think historically, when I think back to conversations I've had with investors that are maybe on the public side predominantly, but obviously this can happen on the private side too. When companies raise such large amounts of money, there is concern about capital discipline, right? I mean, I think in some of the frothier sort of periods of our sector, I don't know how many conversations I've had with investors where they complain about companies that keep raising larger and larger sums of money, but then on the flip side, their quarterly cash burn rates just go up and up and up. And so there's all this concern about capital discipline. So how do you marry up those concepts of being able to deploy such large investments, but at the same time sort of structure those deals such that you can sort of maintain that capital discipline? And so I think this kind of gets into some of the structures that we had talked about.
Yeah, Steve, great question. Really terrific question. And something we think about a lot. And it's really some of our macro thinking of corporate finance over the last 10 years. How do we structure these deals? Because it is a two-edged problem as you defined it. You don't want to undercapitalize companies because you don't want to make them, you don't want to put them in a position to suboptimize their business and technical decision making. At the same time, you don't want to overcapitalize them so they squander capital and don't stay focused. So the way we think about it is we want to make sure that the companies that we partner with and make investments are fully well capitalized to get through the next major value inflection point. Because we don't want them worried about where's that dollar coming from that's going to enable them to have that big readout in the neurodegeneration trial or the breast cancer trial or the vaccine trial, whatever it would be. We want to make sure that they know that they're making the right decisions to run their clinical trials, sit in front of the FDA, the EMA, and other regulatory bodies and launch drugs and medical devices in the best way for ultimate value creation. So we do use some tools and some term sheet optionality where we will capitalize a company, but then give them further commitments as long as certain criteria are met to further capitalize those companies. So the management team knows that as long as things are going well, and as long as within a certain range, they're following the business plan that they had set out for value creation, that additional capital will be available to them. And they won't have to take capital market risk or divert their attention to have to always be looking to raise new rounds. They will know that the capital is there for them. And that's part of what we're trying to accomplish at Bain Capital Life Sciences, which is we want to be true partners with the management teams that are creating the value for our investors. And so we want them focused on that value creation and not having to always focus on raising capital from new sources. Now, once a certain value creation point happens, then there is a time to go back to the capital markets and say, okay, we've achieved this. Now it's time to move on to the next step, or even more scale capital will be needed, and additional investors should come into around the table to be a part of the next stage of growth. So we like to set things up that we know that the management team will have that capital to get to a major value inflection point and then be set up for further capital raises downstream, but when they've really changed the cost of capital in a significant way from when we initially started investing.
In your mind, is this a doing these scaled investments, with 9-figure checks? I mean, is this a sustainable model in your mind?
I think definitely. Now, I can say so for positive reasons, but also for some less positive reasons. First, on the positive side, yeah, I think this idea of using tools such as tranching or gating, where there's an initial set of capital, but then there's commitments as long as the tranching works out and that the sub catalysts are going in the positive direction, and then having access to more capital. I do think we're going to continue to see this. I think this is a healthy way for the market to move forward. Something, though, on the other side of the ledger that's a bit more concerning and more of a struggle for us when you ask about the scale investment is, why is such a large amount of capital required? I'm going to use some round numbers here. So for your listeners, these are not exact numbers, but roundabout numbers. I remember when we came out of the global financial crisis in 2008, 2009, and when the life sciences ecosystem was getting its feet below it again and trying to become an investable area again. You could use a back of the envelope that once you saw good data, good phase 2A data, and you wanted to help bring a drug to market, you could do that for $200 to $250 million and get a drug to market. And that was this post 0809. I'd say now, when we're coming out of the 2021 2022 kind of reset, and now we are in 2026. I'm seeing numbers like it costs $750 to $1 billion from an initial proof of concept to get a drug in the market and an initial launch. I mean, that's 3 to 4 times what that cost was, 15-ish years ago, coming out of the last global financial crisis. That's a radical change, and we're trying to study that, like what's created that change. I mean, there's basic background inflation. But there's some other forces at work as well. I think regulators are requiring more clinical data. The bars maybe have changed. I think companies are relying more on external clinical research organizations to help them get work done. There's more of a need for global patient. So for a variety of reasons, I think you're seeing the cost of clinical development and early commercial launch has gone up substantially. This has required companies, therefore, and required the investments in these companies to really accept a higher amount of dilution and therefore have to raise larger rounds.
Right. Right. Wonderful. Well, thank you very much, Adam. I think we will take a short break and we will be right back.
The BioCentury Show is brought to you by the 5th East-West Biopharma Summit in South Korea. An arc of innovation is emerging across Asia, and Western biopharma leaders are taking note, from cross-border deals to new cos. In March 2026, the 5th BioCentury Bay Helix East-West Biopharma Summit visits South Korea for the first time. Meet the biopharma leaders putting Korea innovation on the global map. Learn why Korea has become a clinical trial and manufacturing hub. Discover if Korea is the next hotspot for new co-formation. Plus, meet biopharma innovators from India to Singapore to China and Japan. Register now at biocenturyeastwest.com.
Welcome back to the BioCentury Show. We are in conversation with Adam Koppel, partner at Bain Capital Life Sciences. So, Adam, a lot of the chatter that I've heard from investors recently is that we're finally at the start of a recovery for the biotech markets after what have been 4 pretty tough years. You've been investing in this space, long enough to have been through multiple cycles. Can you just give me your perspective on, how the current life sciences market environment compares to, say, the end of other prior cycles?
Sure. Well, first of all, I agree with the premise of your question. It has been a challenging 3 or 4 years. I think some of that is extrinsic to our ecosystem, and some of it is intrinsic. And what I mean by that is some of it are things that have happened to us that our ecosystems had very little to no control over, and some of it is self-imposed. Do I think we're in a new era? Well, I certainly think the second half, or probably the last quarter of 2025, was a constructive one, and we saw quite a nice rebound, which I think was welcome for a lot of people in the ecosystem. But there's still a fundamental question, which is, have some of these uncertainties and hurdles really subsided, or are we beyond them? Some of the extrinsic ones, I'm sure you and your listeners have been top of mind. I mean, the ongoing changes at the FDA, the uncertainty about grants and the NIH, grants to basic science, coming from the NIH, the uncertainty around pricing and reimbursement, and the chatter around most favored nation and reference pricing, and also just the general concept of where are interest rates going, how fast will they be going? Most people believe they're going to go down. I think it's just a question of how fast will we see interest rates go down, and where's inflation alongside this tariff story. So I don't think maybe it's the right time for us to go into detail on those, but those are five sort of extrinsic uncertainties that our ecosystem was forced to kind of be focused on in 2024 and certainly the first half of 2025. Are we beyond some of that? Yeah, we're beyond some of it. I think the Trump administration has made deals with the pharmaceutical industry. So I think at least for now, maybe we're at a bit of a steady state on pricing. I don't want to say we're at a permanent steady state, but I think for now the rhetoric will be a little bit lower. But I still think there's uncertainty with the FDA, and I still think there's important uncertainty with the NIH. And in terms of, I think it's very important for this ecosystem to continue to have our relationship with the academic setting and with the basic scientists that are prepping us to be able to run the clinical studies that we like to invest behind. How about some of the intrinsic challenges or issues that we imposed on ourselves, frankly? And I think some of those are, you asked about, what is this time like versus other times coming out of economic uncertainty? Well, again, I'll compare it to either 01, 02 with the tech bubble or 08, 09 with the global financial crisis. Back, and again, these are rough numbers. These are not exact numbers I'm about to cite. But back in 01, 02, maybe there were 150 or 200 companies, public companies in the life sciences biopharma ecosystem. And I think coming out of 08, 09, there are maybe 250 to 300 companies. Right now, the last number I heard is we have 850 publicly traded companies in the life sciences ecosystem and
That
probably
sounds about
over
right.
2,000 private companies. There's just a lot of companies out there. When I was a public investor back in the old days, 20 years ago, we knew every company. We knew the management teams. We knew what they were working on. We knew what the next catalysts were. It's like the challenges now of everyone having to follow, 800 plus companies. It's too much. And also, we alluded before the amount of capital that's required to get companies to major value creation events. It's a lot. It's a lot more than it used to be. And you're having to deploy a lot more capital before you know the answer, when you can be wrong and lose all that capital. So I think those two things have been challenges for the market. And I still think we face those challenges. There's a lot of companies, there's like a war, not only for capital, but for airtime to kind of get people's attention. And I think the amount of capital that's required, I think investors are getting a little bit burnt out by the dilution that they're needed to take to fully get drugs through development. So I think we're in a relative positive period right now, and I do expect the capital markets to remain open and get more constructive in 2026 and hopefully 27. But I don't think we're completely out of the woods in terms of some of the concerns that are the ecosystem itself is having and that generalist investors are concerned about when they look to deploy more capital in the life sciences.
Yeah, no, I think that's a great point. And, I think even back, if you look back at 2021, that number of public companies was even higher. And I remember conversations then where public investors were complaining that I can't even keep up with the number of companies that are coming out. It's too much. It's like drinking from a fire hose.
I think there were over 100 IPOs a year for 4 or 5 years running between 2016 and 21. No, right now, I think we'd be lucky if we have 10 from last year. Yeah,
and I think that's why I think these past 4 years has actually been somewhat important in that respect, is that we've had quite a bit of attrition of some of those of maybe the lesser quality companies, and so that's kind of helped to kind of revert us back to a maybe more manageable number. But just sort of expanding on that point, sort of starting the new year here, I've had a lot of conversations with investors over the past month, as I mentioned. And particularly on the public market side, I think it's kind of gone from what I would say had been sort of cautious optimism at the new year, and it's kind of given way to a lot more just open optimism, I would say, with regard to prospects for biotech this year. But the area where there's been a lot more mixed feedback, I would say, is on expectations for private biotechs in the coming year. I mean, we all know that the private markets tend to lag the public markets, and so maybe the enthusiasm we're seeing now will trickle down through. But what are your expectations for private company financings and transactions, over the next 12 months?
I'm constructive on it. And the reason why is I think there's some really good private companies, right? I think that we're in a good part of the cycle in terms of converting some of the great basic sciences from the last decade or two into practical clinical tools for our clinicians and healthcare professionals to use for patients with unmet medical needs. So one of the reasons why I'm very constructive right now is because I think that there are lots of good opportunities where to drive innovation and bring innovation to the bedside. So that's number one. Number two, I think that and I say this in a positive way, it's an idiosyncratic market. And what I mean by that is, in some ways, investors like Bain Capital Life Sciences and many other investors. I mean, there's 10 or 15 great funds out there that do similar things in the crossover, the early public, and also the venture and the late venture side. I think that the fun part of our market is to identify the next major win, right? The next major, and when I say win, I mean win versus terrible diseases, right? The unmet medical needs. And I think that we're all looking for that. I think we're looking first to help patients, and with that comes profits. And I think that there's also then there's a business force as well, which is large pharmaceutical companies need to reinvent themselves pretty frequently, because even when they get a good commercial winner, they only have a certain limited period of time to realize the good free cash flow from that winner, and they have to continually recycle new innovation. And so I think that's why you see great partnerships between the large biopharma industry and the smaller innovative companies that are developing the earlier stage products. And I think that we are also coming to a point where that relationship, those collaborations will continue to happen and be fruitful. And I think they're win-wins. And so I think a combination of being in a good part of the innovation cycle and a good part of the cycle for collaboration between large revenue generating focused companies and revenue burning, or I should say free cash flow burning innovative companies coming together. I think the combination of those two things is making for an improving environment for the private companies in our space right now.
Yeah. So, over the past, 4 years, I mean, there has been this trend for companies to stay private for longer, right? Mm-hmm. Because we haven't had,
out of necessity, maybe, but
out of necessity for a lot of companies, because we haven't really had a strong IPO market, but now there's obviously chatter growing that maybe this is going to be the year that the, quote unquote IPO window will meaningfully open up. How are you advising your portfolio companies about how to approach any potential discussions on that area?
No, it's a great question. I mean, that's a lively discussion in a lot of boards that I'm a part of. And the first line typically goes from a board to a management team. Just because you can go public doesn't always mean you should go public. Very true. But you're right. There is a mentality now that since the capital markets have been a challenge for the last few years, and there have been so few IPOs, and now that we may be seeing a more open IPO market, that there could be a lot of companies that have been waiting, like a backlog of companies that have been waiting, and maybe they are ready to go IPO. But I think you should really think hard. I think that debate with investors, the boards, and the management teams of companies is going to be robust in the next couple of years. I think certain companies should definitely be public companies. And I think those are the companies that truly need in the hundreds of millions of capital to launch a product. And I think when they also need more of a breadth of support from a lot of investors to enable them to shift from the venture investor or the growth equity investor or the crossover investor to the longer term scale, I'll say large hedge fund or mutual fund investor, there does need to be a changing of the guard of who is owning these assets, especially when you see success. And sometimes the best way to do that is with a public offering. So I think both from a corporate finance perspective, also from a need for scale capital perspective, I think there is a time for certain companies to go public. What I oftentimes hear the next question being in boards is, what is the maturity a company should be in order to give the comfort to the next set of investors to come in? And that's where I think the bar moves, depending on where you are in the cycle. But I think right now we're still at a point where I think you need good clinical data to have a strong IPO. Now, I could be wrong on that on some outliers, but I think whereas in 2019, 20, in the early part of 21, I think we saw some platform companies and some preclinical companies going public. I think as the markets open up, I don't think you're going to see a ton of those in the early stages of this IPO window. But I do think you're going to see some of the stronger companies that have good phase 2 data and even the early start of phase 3. Those, I think, are the companies that we're going to see coming out.
Right. No, and I think, as you mentioned, I think there's a pretty large backlog. There are quite a few of those sort of post proof of concept sort of private companies that should be there. But since you mentioned it, Adam, I do want to follow up on one of your comments here. Do you think there's ever a good argument for a preclinical company being funded by public market investors? I mean, you mentioned the platform companies. There obviously we had the hype around the gene editing companies, sort of, back in the 2021, that you referenced. Is there ever really a good time to have a preclinical company?
That's a bit of a controversial question. So I will say I'm probably known for being an extreme on my answer here. So I'm going to give a soft answer and say, it's not the investment style that I think my team and I like to take. I think you're exposing a management team to a lot of uncertainty and a lot of disclosure requirements that really could be a disservice to them when it's in the preclinical or very early clinical stages, or when it has the potential to be an exciting platform, but it's just not known yet what the characteristics look like of the lead offering. I think it can be, in a way, I'm going to use the term a winner's curse. So what I mean by that is, yes, you may win, you may go out and go public. And I think some management teams see it as like their graduation or their big win. I go and tell them, no, this is the beginning. This is the commencement of the next stage. And sometimes it can be harder for you to manage a public company than when you could have been a more stealthy private company. So I think it's a challenge bidirectionally. I think it's a challenge for the investors to really be able to underwrite and understand what the risk reward and the potential is for a platform and for kind of preclinical assets. And I think it's a challenge to those management teams to how to make ultimately NPV maximizing decisions when they are public and they have the requirements of quarterly reporting and disclosure.
Sure. So one of the major trends that we saw last year that I think is really carrying through to this year as well is this concept of the NewCo model, right? So this is where VCs, can build sort of Western-based companies around assets, in particular in this version of it, right? They're often licensed from Asia, specifically from China. Can you talk a bit about Bain's sort of own experience in doing these NewCo company builds? And I think the main follow-up I have to that is, how sustainable do you think that model of company building is?
Well, let me answer your last question first and say I think it's very sustainable. I think it's going to be the source of capital for a lot of new companies. So I'm quite optimistic and constructive on this. We call it the SpinCo NewCo sort of model. And it was something that our view on this and our understanding of how these best work has really evolved over the last 10 years as we've participated in that market, and we've learned from mistakes and we've also learned from some of our successes. Before I get in specifically to the China question or the Asia question, it's just a broader sense of why are these working? And I think they're working because a lot of very successful, great companies have more assets in their pipeline than they have capability to develop. And what I mean by capability, obviously they have huge, very strong balance sheets, strong free cash flow, great managers. But at some point you need to focus. And I think some of the large companies have decided that they'd rather focus on a handful of therapeutic area priorities, disease area priorities, but not do everything. They can't be all things to all people. And I think they also recognize that although they do have strong balance sheets and free cash flow, they also want to return profits to their investors and show free cash flow progression and growth. And so they can't invest in everything. And the third point, I think, is that it's an opportunity for these larger companies to separate out certain good assets and have the opportunity for them to create value outside of the purview of that parent company, but also giving the opportunity for some up-and-coming managers to be able to lead companies. Oftentimes, these are managers that have come from large pharma, but focus every day on a smaller subset and have value creation. And then oftentimes, if they're successful, they'll go back into the large company for ultimate launch and commercial optimization. So we have done this a couple of times, most notably two great deals we did with Pfizer. And Pfizer has been a great partner for Bain Capital Life Sciences in a number of dimensions, but that was SpringWorks and Cerevel. And now we've done some other deals more recently, and a number of those deals have been in Asia. So this brings up now this concept of what's going on in Asia and our ability to partner with some Chinese companies and Japanese companies for that matter. So we have found this to also be a great place to look for new and interesting assets, improved assets for patients with unmet medical needs in an area where there may be better capital efficiency in the early stages of drug development. I'll call that the late preclinical and the early clinical. So yes, we do believe that it can be more capital efficient there. We've had some successes there. We have some great partnerships in Asia as well with the likes of Hongray and Mitsubishi Chemicals with Tanabe. And on both of those examples, we have found partners and collaborators that we can do good business with. There's a great trust, there's a great mutual respect, and there's an understanding that we offer some advantages, and they offer some advantages. And when we create newcos in collaboration between the two, you can have win-wins for everyone involved. So yes, I think that we are very constructive on these types of deals continuing to happen. I know that there are some uncertainties, and I know that there's some risks, but net, we think we're going to see more of this.
Yeah, wonderful. Well, great. Well, I think that's all we have time for, Adam, but thank you so much for joining us as the first guest of 2026. Awesome conversation. Thank you. And thank you, listeners, for joining us, and we will see you next week.
Thank you, Stephen.
Brought to you by the 5th East-West Biopharma Summit in South Korea. In March, explore how to globalize Asia innovation and connect with key players across Asia's innovation arc, from India to China to Japan.
Kendall Square Orchestra provides the music for the BioCentury show. The group connects science and technology professionals and other members of the greater Boston community to collaborate, innovate, and inspire through music while supporting causes related to healthcare and education.